Welcome to the Deep Dive. Today we're digging into the recent earnings call from Brookfield Infrastructure Partners, BIP, for their Q3 2025 results.
Yeah, the call was pre-market November 7th, and the market reaction, it was, pretty positive, actually. Kind of a sigh of relief, maybe.
Exactly. A reassuring signal?
Yeah.
It suggests the results were solid, and the outlook is, well, firm.
And the story here isn't just the numbers, it's really about their strategy, isn't it? This whole balancing act.
Right. Capital recycling, on one hand, selling assets, but then deploying that cash into these big secular trends.
All while keeping the balance sheet strong. That's the core narrative they pushed.
And that's our mission today. We need to unpack how they pulled off like 9% FFO growth year over year, while also selling off more than $3 billion in assets this year alone. Seems counterintuitive.
It does. And then there's this big push into AI infrastructure. What does that really mean for the next, say, year and a half?
Let's start with those headline numbers that set the positive tone.
Okay, so GAAP EPS, that was the first kind of big surprise. A real beat at $0.44 per unit.
Yeah, the analysts were way lower, weren't they? Like $0.28 to 31 cents rate.
Exactly. So $0.44 looked really strong right off the bat.
But for infrastructure, FFO funds from operations, that's really the number everyone watches. The distributable cash. How did that look?
Non-GAAP FFO per unit came in at $0.83.
Okay, $0.83. So that was more expected.
That's in line, yeah. Though maybe a slight miss compared to the very top end of estimates, which is around $0.06. But context is key here.
Right.
Revenue was almost $6 billion, $5.975 billion, actually. That's up a solid 13% year over year. Pretty strong growth.
And the distribution from the earnings don't come thick.
Good news there, too. They bumped it up to $0.43 per unit quarterly. That's a 6% increase from last year, keeping right on track with their target growth.
Okay, so headline numbers look decent, distribution growing, but that 9% year-over-year growth in total FFO hitting $654 million.
Yeah.
Let's get into that. How do they manage that despite selling assets?
That's the impressive part, right? It really highlights the underlying strength of the assets they kept. The organic growth was clearly very strong to offset the cash flow they lost from the sales.
So let's break it down by segment, because one segment wasn't just strong, it was, well, explosive. Data.
Oh, yeah. The data segment FFO was up over 60% compared to last year. A huge jump.
60%? Wow. What drove that?
Two main things. First, getting the full contribution from that big India Tower portfolio they bought. And second, just pure organic growth from building new stuff.
A new capacity coming online.
Exactly. They commissioned 80 megawatts, MW, at their big hyperscale data centers globally. Plus, they started billing for another 45 milliW at their U.S. retail sites. That's real capacity turning into real cash flow fast.
Okay, so data is booming. What about the more stable side, like utilities?
Utilities did well, benefiting from inflation protection built into their contracts. That's obviously helpful right now.
Plus ongoing investment.
Yep, they put another $450 million plus into the rate base this quarter. That builds future earnings. But it wasn't all smooth sailing.
Higher borrowing costs. Maybe.
That was part of it, yeah. Higher borrowing costs took a bite. And they also felt the loss of income from that Mexican gas business they sold earlier. So positives and negatives there.
Got it. And transport and midstream, usually pretty steady.
And they were. Underlying performance was solid. Good volumes, good rate increases on things like rail and toll roads.
Even with more asset sales impacting that segment too. I remember they sold an Australian terminal and a U.S. gas pipeline.
Right. Those sales were a headwind. But the midstream side got a boost from the partial contribution of that Colonial Enterprises deal. They did the refined products pipelines. So it helped balance things out.
This constant selling and buying,
yeah,
it really is their core playbook, isn't it? This recycle and reload.
Absolutely. They're very disciplined about selling assets when they think they've maximized the value, and they're good at it.
The numbers certainly suggest that. Over $3 billion in proceeds so far this year from 12 deals.
And look at the returns they're getting on those sales. The IRR internal rate of return was at over 20%.
20% plus IRR. That's phenomenal for infrastructure assets.
It really is. And the MOIC multiple on invested capital is around 4x.
4 times their money back.
Yeah. For every dollar they put in initially, they got 4 back when they sold. It shows they pick assets well, and maybe just as importantly, they time their exits really well.
Okay, 4x MOIC is great, but it raises that classic question. When you sell something like that North American gas storage business through the Rockpoint IPO, right? Are you selling off really stable, high-quality assets just for cash now? Selling the crown jewels, so to speak?
That's always the pushback. Management's argument, and history kind of backs them up, is that they sell when the major value creation is done and the growth slows down. With the gas storage sale, they got a 3.2x MOIC, freed up a lot of capital, but they also kept a decent stake, so they still benefit from its stability, but now they have cash for higher growth stuff.
And that Rockpoint IPO was a big deal itself, wasn't it? Largest on the Toronto Exchange in a while.
Yeah, largest since May 2022. Showed there was huge demand for that type of asset they built up.
Okay, so the recycling is generating cash and good returns. Let's talk reload. Where is that cash going? What's in the deployment pipeline?
It's very focused on those big trends. They locked down 3 new deals this quarter.
Okay.
There's a $1.3 billion deal for a gas infrastructure business in New Zealand. That should close Q2 next year.
Right.
And then a $1 billion industrial gas business in South Korea. This one looks really interesting.
Why is that?
Super defensive. It's basically locked in with 20-year minimum take-or-pay contracts with major semiconductor companies. Think really reliable, long-term cash flow, basically replacing the stability they sold off.
Makes sense. Replacing stable cash flow with new stable cash flow. But then there's the big growth play, the AI infrastructure angle. That feels like the main event going forward.
It absolutely is. This is the big catalyst everyone's watching. They announced a massive framework agreement with Bloom Energy, up to $5 billion.
$5 billion. Wow. What's the goal there?
To build up to 1 gigawatt, 1 GW of power solutions right at data center sites.
Behind the meter power.
Behind the meter. So bypassing the grid bottlenecks.
Exactly. That's the huge problem for building new data centers, waiting years sometimes to get hooked up to the grid. BIP and Bloom plan to provide on-site power, solving that problem. It leverages BIP's infrastructure know-how directly into the hottest market.
And is this just a plan, or is it happening?
It's happening. The first project under this deal, a 55 million hyperscale site, is already underway. So real execution, not just talk.
Okay, tangible progress there. Let's connect this back to the finances. How's the balance sheet holding up with all this activity? Can it support this reload?
Seems rock solid. They've got $5.5 billion in liquidity available. $2.5 billion of that is cash, right at the corporate level, ready to go.
And they're accessing debt markets? Okay, rates are high. They just issued $700 million in medium-term notes at around 4% interest.
4%. In this environment, that's really good.
How? Management credits their global scale and the low-risk nature of their core assets. Think regulated utilities, long-term contracts. The market clearly trusts them. And they've turned out their debt really well.
Meaning?
Less than 1% of their non-recourse debt matures in the next year. The average maturity is about 7 years out, so they're really well insulated from near-term interest rate hikes.
No wonder management sounds confident. They use the phrase inflection point for the business's growth.
Yeah, that signals they think things are about to accelerate, driven by, digitalization, decarbonization, these huge trends creating opportunities they think can beat their usual 12-15% return target.
And they put a number on the AI part specifically?
They did. Committed to deploying up to $500 million a year into AI-related infrastructure over the next few years. That's a serious ongoing commitment.
They also talked about their own shares, right? The difference between the BIP units and the BIPC corporate shares and that price gap.
Right. The BIPC shares usually trade a bit higher than the BIP units. It's a structural thing.
So what's the plan?
It's a bit complex, but clever. They're thinking about using an at-the-market program, an ATM, to issue more of the expensive BIPC shares.
Okay.
And then using that cash to buy back the cheaper BIP units through their buyback program, the NCIB.
Ah, so sell high, buy low, basically, using their own shares.
Pretty much. The goal is to boost liquidity for the BIP units, hopefully close that price gap between the two, and do it all without actually diluting existing shareholders overall. It's financial engineering to fix a structural issue while raising capital efficiently.
Very neat, if they can pull it off smoothly. Okay, last thing from the Q&A. Anything interesting on competition? Because everyone wants data centers and energy assets now.
Yeah, they got asked about that. Management was pretty clear. They're trying not to get into bidding wars based just on cost of capital.
So how do they win?
By leveraging their global reach and expertise to do complex deals others can't. They specifically mentioned sovereign compute projects.
Sovereign compute? Like building data infrastructure for governments.
Exactly. Deals where just having money isn't enough. You need trust, regulatory know-how, the ability to handle complexity across borders. That's their edge.
Plus, they have existing assets they can build out, right?
Huge point. They talked about their center square data centers, potential to multiply the capacity by 3 or 4 times just within the existing buildings. Massive embedded growth potential that others don't have.
Okay, lots to digest there. Let's pivot to our favorite segment, not financial advice.
Yes.
Based on everything we just heard, the capital structure stuff, the AI pipeline, what's a potentially outrageous but maybe plausible trade idea?
All right, thinking creatively here, I see a 2-part synthetic trade. It tries to capture both the near-term financial maneuvering and that longer-term AI growth story. Definitely aggressive.
Okay, lay it out. Leg one.
Leg one is a direct bet on that spread closing between BIPC and BIP, the spread arbitrage play.
So, long BIP, short BIPC.
Exactly. You go long the cheaper BIP units and short the pricier BIPC shares. You're betting that their ATM and CIB plan actually works and brings those prices closer together.
Risky. Depends on execution, but follows their stated goal.
Okay.
Leg two. How do you play the AI angle?
Leg two is all about that AI FFO inflection. You need to look further out. Given the $500 million annual spend and that big Bloom Energy deal, maybe a long-duration option strategy.
Call options.
Yeah, buying call options on BIP, maybe targeting 12 to 18 months out. You're trying to time it with when those first big AI projects, the hyperscalers, the first Bloom deployments, really start hitting the FFO numbers. The idea is to capture that growth before the market fully prices it in.
So a pairs trade on the structure now, and long-dated calls on the AI growth later.
Interesting. Okay, wrapping this up. If you had to boil it down, what are the key takeaways for our listeners?
I'd say 3 things. 1, capital recycling is not just happening, it's working incredibly well, 4x returns, providing fuel for growth.
2, the balance sheet looks really strong. They've managed their debt well, locked in low rates, plenty of liquidity, low risk there.
Got it. And 3,
3, the data segment is shifting into high gear, especially with that strategic AI push through Bloom Energy. It really sets the stage for FFO per unit growth to, as they said, inflect higher.
a solid story of execution and future planning. But maybe one final thought for everyone listening. They mentioned those complex sovereign compute deals take time. Diplomacy.
Yeah, dealing with the governments isn't quick.
Exactly. So the question is, how fast can those non-hyperscale, more complex AI and data projects actually start showing up in the FFO numbers in 2026? The speed of executing those tricky deals might be the real story next year.
Good point. Execution on those unique, complex deals is definitely the next hurdle to watch.
All right, that's our deep dive for today. Hopefully you can connect this insight to your own investment thinking. Thanks for joining us, and we'll catch you on the next one.